It has been reported that the United States has instructed Chinese airlines to suspend the reception of new Boeing aircraft and to avoid purchasing aeronautical components from American companies. Additionally, tariffs of up to 145% have been applied. So far, it is known that the Chinese government has asked its airlines to temporarily halt the incorporation of Boeing aircraft into their fleets. When Hollywood-style drama moves to the skies, a multi-billion-dollar showdown emerges between Boeing, China, and a dispute of gigantic proportions. Trade tensions between the two nations have officially entered a new phase. Stay ahead of the curve with the latest in tech. Subscribe to Data Dollar now and never miss an update on the innovations that are shaping the future of business and technology. Join our community. The aviation sector becomes the protagonist, and like any blockbuster story, there's a key figure facing turbulence: Boeing. Think of this as a high-voltage global thriller, where jets replace movie sets and the narrative tension translates into multi-billion-dollar losses. Recently, China's Civil Aviation Administration informed Boeing to suspend all deliveries, triggering immediate effects. The company's stock plummeted. The reason? It wasn't a simple technical problem, but a strong signal that the trade dispute between Washington and Beijing has escalated to a deeper and more delicate stage. It's no longer limited to tariffs on electronics or clothing. It now involves airplanes, the people who operate them, and global profits affecting individuals and companies around the world. Let's look at some concrete figures. By the end of last year, Boeing had a backlog of about 4,500 aircraft pending delivery, and over a quarter of those orders were tied to Chinese airlines and leasing companies. That represents a massive share of the business. To put it into perspective, a wide-body aircraft is priced at around $300 million, while a narrow-body one is about $110 million. Even after standard discounts and negotiations, Boeing's contracts with China generate between $10 billion and $12 billion annually, considering just the initial cost. Adding services, spare parts, and maintenance pushes that number even higher. Thus, when China announces a delivery pause, it's not just about halting planes, it's about freezing billions in expected revenues. It delivers a strong blow to Boeing's financial balance. Wall Street reacted nervously. Within days, the company's market value dropped by about 10%. And this loss isn't just from the current suspension. There's a real fear among investors that this is only the beginning and that new measures against Boeing may follow. There's even speculation that China could shift its preference to Airbus, its European competitor, or ramp up investment in its national manufacturer, Comac. Take 2024, for example. Combined aircraft orders from China to Boeing and Airbus reached approximately $14.5 billion. If Beijing redirects part of that budget to Airbus, Boeing's share could shrink to just $5 to $6 billion. This income drop would directly impact its stock value, potentially resulting in a market capitalization loss of up to $40 billion. In conclusion, it's not just Boeing under pressure, it's the entire US aerospace industry. Let's look at the broader picture. Aviation is one of the sectors where the US leads in exports. International aerospace sales, led by Boeing, range between $130 billion and $140 billion annually. China accounts for between 15 and 18% of that total. A mere 1% reduction in this market translates into billions in lost exports. And it's not just planes at stake. Boeing's supply chain is vast, spanning almost all 50 states. From electronic systems to engines, from landing gear to seats, thousands of small and medium-sized companies participate in the production of each aircraft. If business with China halts, it could trigger layoffs and cuts in numerous industrial towns. Industry analysts already warn that engine suppliers could cut between 5,000 and 10,000 jobs before the end of 2025. However, there's an important twist in this story. For China, replacing Boeing is no simple task. Chinese airlines heavily rely on models like the 777, 787, and 737 MAX for international flights. Switching to Airbus or Comac would mean months of pilot training, maintenance infrastructure modifications, and system updates, with multi-million-dollar costs and potential flight schedule disruptions. What we're witnessing isn't just a simple trade dispute. It's an economic standoff with global consequences. Boeing is facing one of its most complex international challenges in recent times, and the outcome could reshape the world aviation map for years to come. Behind this story are also strategic challenges for China. While Beijing aims to show strength by cutting ties with Boeing, the reality is that its national manufacturer, COMAC, is not yet fully ready to compete. It's still uncertain how long it will take to operate at full capacity. In other words, China is accepting some short-term consequences, but its bet seems to be that the US will lose even more. It's a risky move, rooted in a classic win-lose logic of trade wars. Both powers are standing firm with no intention of backing down. Let's look at the numbers. The tariff dispute is intensifying. Washington has already imposed levies ranging from 25% to 50% on certain Chinese technological and industrial products, and there are threats of raising them above 100% on some strategic goods. China's response has been to restrict key US imports, like agricultural goods and energy resources. Now it has added an unexpected measure, suspending the acquisition of short-haul commercial aircraft. With this, Boeing's entry into the Chinese civil aircraft market is virtually closed off. Let's talk about what's at stake. Previous Boeing-China deals could have been worth between $150 billion and $160 billion. If even a fraction of that shifts to Airbus or another company, Boeing's financial future darkens, with long-term revenue losses already looming. The stock market has reacted. In just 1 week, Boeing lost between $15 billion and $20 billion in market value. This isn't Boeing's first complex episode. The company is still grappling with over $20 billion in losses, stemming from the 737 MAX failures during the pandemic. This new phase of the trade conflict threatens to plunge the company into another economic crisis. Sector experts warn that if China maintains its stance for the next 6 to 12 months, Boeing's delivery revenues could fall by 20 to 25%. This isn't just a statistic, it's a direct threat to jobs. Boeing employs around 140,000 workers, about 30,000 of whom are involved in commercial aircraft production. A mere 1% drop in profit margins could put thousands of these jobs at risk. What began as a political strategy could end up having its most serious repercussions among American workers, a boomerang effect that threatens to close the circle. Beyond the economic sphere, this conflict has a strong geopolitical component. China and the United States have long walked a thin line between cooperation and competition. As tensions rise, especially with Washington's technology restrictions, Beijing seems determined to gain an advantage. And what better symbol to strike than Boeing, a beacon of US industrial excellence? By pausing aircraft receptions, China isn't just hitting one company. It's sending a clear and powerful message. It's also seizing the opportunity to boost its local industry. COMAC aims to deliver 150 C919 aircraft by the end of 2026. If Chinese airlines drop Boeing and adopt COMAC, Beijing could frame this as a patriotic victory. Nevertheless, the C919, although designed to compete with Boeing's 737 MAX and Airbus's A320neo, has yet to achieve international recognition. It lacks key certifications, and its export potential remains limited. Still, China's massive domestic market might be enough to keep COMAC alive and growing. Although China's strategy is ambitious, it carries risks. International regulatory bodies like the US FAA and the European EASA are closely monitoring. If COMAC's models don't meet global safety standards, their international presence could be cut short. Meanwhile, the Biden administration is trying to calm tensions through quiet negotiations aimed at excluding Boeing from the broader trade conflict, hoping to shield the aerospace sector even if other industries remain under tariff pressure. There is historical precedent. In previous disputes, both nations have made exceptions for certain goods, like soybeans or strategic minerals. But now the stakes are higher, and the political context is more delicate, with US elections around the corner. Both Democrats and Republicans need to show strength against China, and any sign of concession could be perceived as weakness. Beijing also faces pressures. Its economy is slowing down, its real estate market is faltering, and it is enduring US sanctions. Both powers are trapped in a high-risk game, and neither wants to be the first to blink. Meanwhile, global aviation is caught in the middle of this storm. And the story doesn't end with Boeing. Behind every plane are multiple key players, suppliers like Spirit Aerosystems, RTX Corporation, formerly Raytheon, and GE Aviation rely on Boeing's production pace like clockwork. If production slows, orders for engines, parts, and tech systems decrease, affecting material makers and software developers alike. It's as if a blockbuster movie lost its lead actor. The entire crew feels it. And it doesn't stop there. Thousands of subcontractors, from family businesses to high-precision tech companies, are part of this network. When orders are suspended, so is innovation investment. That puts crucial advancements, more efficient planes, less polluting engines, even electric jets, on hold. It's like delaying the next installment of a beloved saga the world is waiting for. The historic rivalry between Boeing and Airbus, already filled with twists and tensions, could now enter a new act, a geopolitical conflict. China leaning toward Airbus could boost the European manufacturer short-term, but if Airbus is seen as facilitating China's challenge to the US, it too could face pressure from Washington. Meanwhile, countries across Asia, Africa, and Latin America, which once decided based on cost or availability, could now face a dilemma: align with the US legacy or side with a player in the middle of a trade dispute. This global fracture could fragment the industry, complicate access to spare parts, drive up maintenance costs, and ultimately raise airfares. In cinematic terms, it's as if a successful saga was split between two rival studios that don't share sets or special effects. Everything becomes slower, more expensive, and more complex. What began as a conflict over tech tariffs and electric cars has now taken to the skies, putting billions in orders on hold. Boeing, a symbol of American ingenuity and a global aviation benchmark, finds itself trapped in the script of an unwanted trade war. China's strategy is bold: withstand short-term turbulence in exchange for future independence. Meanwhile, the US tries to contain the damage and protect its political image. At the heart of it all are real people, technicians, engineers, workers, and their families, whose futures hinge on every order cancelled or delayed. The big question is, will diplomacy prevail, or will the conflict escalate further? Whatever the outcome, one thing is clear: the next chapter of this story will not only define the fate of Boeing and Airbus, but also the future of global transportation, commerce, and technology. If you enjoyed the video and would like to continue learning about technology and markets, subscribe to Data Dollar and leave a like. See you next time.